It's late at night. You're half tired, half productive, scrolling through a checkout page. New laptop, better chair, software subscription you don't really need yet, and then the thought hits you. It's fine. I'll write it off. You feel a little smarter, a little relieved, like the system just gave you permission. I've been there. I remember sitting at my desk, receipts spread out, telling myself I was being responsible, optimized, strategic. This wasn't spending, this was tax planning. And here's the moment you didn't realize mattered. The click didn't just move money out of your account. It rewired how you decide. Because you thought the deduction was saving you money. It isn't. What's actually happening is quieter and way more expensive. By the end of this, you'll see tax write-offs differently, and you'll know exactly what to do next time before that justification even forms. Let me slow this down. A tax write-off does one very specific thing. It reduces the amount of income you're taxed on. That's it. It does not refund your purchase. There's no reason to save this price. That's far more competent than they would be and conservative about what it takes. And yet, psychologically, we treat it like a discount. This is what I call the discount illusion. The discount illusion is when your brain converts a partial tax reduction into a perceived price cut, even though most of the cost still comes straight out of your pocket. The label deductible lowers your internal resistance to spending. It turns a maybe into a yes. And once that switch flips, everything downstream changes. At the daily level, it looks harmless. You expense meals you could have skipped. You upgrade tools earlier than needed. You say yes to subscriptions because it's business anyway. Each decision feels rational in isolation. But something subtle is happening. The write-off becomes permission. Not strategy, permission. Then it escalates. At the medium level, purchases get bigger. You upgrade equipment instead of squeezing value from what you have. You choose the nicer option because after taxes, it's not that bad. You start thinking in after deduction prices instead of real cash prices. Here's the dangerous part. You stop asking, would I buy this if it weren't deductible? That question disappears. And at the life level, this is where people get confused. They're working more, earning more, optimizing harder, yet cash feels tighter. Businesses feel fragile. There's always another expense justified by future efficiency, another write-off that was supposed to help. Let me show you why the math never matches the feeling. Keep this simple. If we assume a 25% tax rate, not exact, just illustrative, and you spend $1,000 on something deductible, the tax savings might be around $250. That means you still paid $750. You didn't save $250. You spent $750. But the discount illusion flips that framing. Your brain highlights the $250 saved and blurs the $750 gone. That emotional math is backwards, and systems love it when you do that. Because the system doesn't need you to be reckless, it just needs you to be slightly miscalibrated. Slightly too generous with yes, slightly too proud of being tax smart. And none of this is because you're bad with money. This isn't you being stupid. This is design. Tax language is complex on purpose. Write-off sounds like erasing a cost, not partially reducing taxable income. Advisors, platforms, sellers, they all benefit when you spend confidently under the banner of optimization. Even culturally, we praise people who know how to play the game. But here's the uncomfortable reframe. If a deduction causes you to spend money you wouldn't have otherwise spent, it didn't save you money. It cost you money. And once you see that, you start noticing how often the decision wasn't driven by need or return or leverage, but by the illusion of cleverness. That's the first crack in the story. And from here, the consequences compound. Once the discount illusion is in place, it doesn't stay small. It climbs. Here's how the escalation really works. At the base level, it's friction. Or more accurately, the removal of friction. The tax deduction lowers the emotional cost of spending, not the financial one. So the first thing that changes is speed. You decide faster. You hesitate less. You justify quicker. That alone is powerful. Then comes the second run, scale. Because once something is framed as partially paid for by the tax system, your brain stops entering to the full price. You don't ask, is this worth $2,000? You ask, is this worth $1,500 after deductions? That question is already compromised. This is classic anchoring. The initial number your brain grabs isn't the real cost, it's the adjusted one. And every comparison after that is distorted. Now, layer in loss aversion. Loss aversion is the bias where losses feel more painful than equivalent gains feel good. In the context of write-offs, it shows up as this quiet fear. If I don't spend this, I'm leaving deductions on the table. That's not rational, but it's incredibly persuasive. You're not spending to gain value anymore. You're spending to avoid the feeling of loss. That's how tax season quietly becomes shopping season. And this is where the system locks in. Because who benefits when you think this way? Sellers do. If something is framed as business deductible, your price sensitivity drops. Platforms do. Subscription models thrive when friction is low and cancellation requires conscious effort. Advisors sometimes do, not because they're malicious, but because their value is framed around optimization, not restraint. Even the tax code benefits in a strange way. Complexity creates dependency. When rules are hard to understand, people outsource thinking. And when thinking is outsourced, narratives fill the gap. One of those narratives is smart people use write-offs. That identity hook is powerful. Once you see yourself as someone who's financially savvy, tax efficient, playing the game, consistency kicks in. You want your actions to match that identity. So you keep spending in ways that look smart, even if the results feel heavy. Let me give you a real-world style example. No numbers you have to trust, just logic you can inspect. Imagine two people with the same income. Person A buys something only if it clearly increases output or long-term value. They ignore deductibility until after the decision is made. Person B buys things earlier, bigger, and more often because they're deductible. They upgrade sooner. They accumulate tools. Their expense list looks impressive. On paper, Person B looks more optimized, more strategic. But cash flow tells a different story. Person A keeps optionality. They have room to maneuver when revenue dips. Person B feels pressure. Every month has commitments that once felt justified. And the kicker is, both paid real money. The tax code didn't reimburse anyone. It just changed the timing and framing of pain. This is how write-offs quietly turn into lifestyle inflation for people who don't even feel like they're inflating. And it doesn't stop at money. Decision quality erodes. When deductibility becomes part of the justification, you stop sharpening your thinking. You don't squeeze value. You don't test assumptions. You don't ask hard questions like, what would happen if I didn't buy this? You assume progress because activity feels like momentum. That's the deepest cost. Because the real advantage in money isn't clever deductions, it's clean decision-making under uncertainty. It's knowing when not to act. The system doesn't reward that directly. It can't monetize restraint. So the loud advice is always about doing more, optimizing more, capturing more benefits. Quietly, the people who build durable wealth do something boring. They treat tax effects as secondary. They decide first, then they optimize. Everyone else reverses that order. And here's why this persists. Even when people feel stressed, the feedback loop is delayed. The pain doesn't show up at the point of purchase. It shows up months later as pressure, or fragility, or the sense that you're running fast but not getting ahead. That delay protects the illusion. By the time you feel the cost, it's hard to trace it back to the moment you said, "It's fine, I'll write it off." But once you connect those dots, you can't unsee them. Because the truth is simple, even if it's uncomfortable. A tax deduction can only reduce a cost that already makes sense. It cannot rescue a bad decision. And it definitely cannot turn spending into saving. The moment you use it that way, the system wins, not because it tricked you once, but because it trained your instincts. And that's what we're going to dismantle next. So let's talk about where this actually goes wrong in real life. Not in theory, not in textbooks, but in the patterns I keep seeing over and over. Here are the most common mistakes people make with tax write-offs, spoken plainly, the way they actually happen. Mistake 1. Treating deductions like discounts. If you wouldn't buy it at full price, a partial tax reduction doesn't magically make it smart. That's the discount illusion doing its job. Mistake 2. Buying to lower your tax bill. This one sounds sophisticated, but it's backwards. Spending money to avoid taxes only makes sense if the spending itself produces value. Otherwise, you're paying $1 to save a fraction of a dollar. Mistake 3. Ignoring marginal reality. People talk as if every dollar is taxed the same way. It isn't. Deductions only reduce tax at your marginal rate, not the full amount. The write-off is smaller than your intuition tells you almost every time. Mistake 4. Confusing expenses with investments. An expense disappears. An investment compounds. The tax code uses the same language for both, but your bank account doesn't. Calling something business-related doesn't give it a return. Mistake 5. Letting identity drive spending. I'm the kind of person who optimizes taxes. That sounds good until it becomes a script that pushes you toward unnecessary complexity and constant upgrades. Mistake 6. Timing games. Rushing purchases at year-end just to capture deductions, without asking whether the timing actually helps the business or your life. Urgency created by the calendar, not by need. None of these come from greed or ignorance. They come from a system that rewards action and hides cost. So here's the defense playbook. Not complicated, not flashy, just rules that neutralize the illusion. Rule 1. Decide in a tax-blind frame first. Ask one question before anything else. Would I still buy this if it weren't deductible? If the answer isn't a clean yes, stop. Tax benefits only enter the conversation after the decision passes this test. Rule 2. Anchor to cash, not savings. Train yourself to say the full number out loud. Not, it's basically $750 after taxes, but this costs $1,000 in cash. Cash is real. Tax effect impacts are secondary. Rule 3. Separate expense from justification. If you need to explain a purchase by talking about the tax code, that's a warning sign. Good decisions stand on value, leverage, or necessity, not clever framing. Rule 4. Delay when deductibility feels exciting. If the thought "this is a write-off" gives you a dopamine hit, wait 48 hours. The illusion weakens with time. Real value doesn't. Rule 5. Optimize last. High performers decide, execute, then optimize. Strugglers optimize, justify, then hope execution works out. The order matters more than the tactic. This isn't about avoiding deductions. It's about refusing to let them drive the bus. Because the people who actually win with money aren't the ones who squeeze every technical advantage. They're the ones who make fewer bad decisions in the first place. That's the identity shift. Be the person who doesn't confuse clever with wealthy. Be the person who understands that restraint is a skill, not a lack of ambition. Be the person who can look at a smart move and still say no. When you do that, tax write-offs return to their proper place, a side effect, not a strategy. If this reframed how you think, don't keep it to yourself. Share it with someone who's always talking about write-offs but never feels ahead. And if you want to stay sharp in a world designed to blur financial thinking, subscribe. Not for hacks, for clarity.